Hey everyone, welcome to Easy Economics. How are you all doing? I hope you all are doing good. Today I brought for you all a brand new series for topic, the highly tested topic, one of the most fundamental topics of macroeconomics, balance of payment. In the first part of today's tutorial, we will be looking at what do we mean by balance of payment, what are the different sections of balance of payment, what do we mean by current account, what are the four components of current account, and how are exports and imports affected. In the second part, we'll be looking at what are the causes and consequences of a current account surplus and deficit, and what are the policies in order to have a, a sound balance of payment stability. So let's begin. Balance of payment, or known as BOP, is actually a record of all the economic transactions between the residents of one country with the rest of the world, particularly in usually a year. So it's measured over a year. And how would we define it? It's actually a record of all the economic transactions that one country does with the rest of the world. Usually it's measured over a year. So the question which now arises is, who actually makes these transactions? These transactions are made by individuals, firms, and the government. Now, the best way to know how a transaction is going to affect the current account is to look at the movement of money. If by way of a transaction, the money is coming in to the country, so it would be recorded as a credit item. However, the transaction is causing money to leave out of the country, we would record it as a debit item. So this is usually a way in which they test us. Questions are there in paper 1. So a lot of content of BOP is tested in paper 1 by way of MCQs. They either ask us questions regarding any of the four components of the current account. They give us questions in which they have given us figures, and they ask us to calculate the current account balance, or they ask us if this particular transaction deals with this particular component of current account or not, or an entire question is made of data response on BOP, and it's even a part of our section B questions. All right. So the first section of balance of payment, or famously is known as current account. So current account is actually the first section of the balance of payment. So what do you mean by current account? Current account shows income received by the country and the expenditure made by it in its dealings with other countries. So what does current account shows? How much expenditure is made by the country and how much income is received by it. A further current account has 4 parts. Now what are those 4 parts? Trade in goods, trade in services, primary income, and secondary income. Trade in goods, trade in services. When we add the balance of trade in goods and trade in services, we get balance of trade, BOT. Trade in goods, trade in services, primary income, and secondary income. These 4 components, when we add, we get the current account balance. Now, what do you mean by trade in goods? This section shows the value of exported goods and the value of imported goods. So, how much a country exports in terms of its goods, not services. They're only talking about goods over here. And how much it imports in terms of its goods. It covers items such as food, machinery, cars, furniture, that means durables, as well as perishables, right? also called merchandise exports and imports or visible exports and imports. So, since it's only dealing with goods, that is why it's also referred to as visible exports and imports. The second part is called trade and services. But before that, what do they say? If revenue from the export of goods exceeds the expenditure from import of goods, we would say that we have a trade in goods surplus. Obviously, when a country is able to make more exports and it makes less imports of goods, what would it have? Money it earned was more relative to the money it paid. The expenditure it incurred was less in comparison to the revenues it received. So obviously the country is going to be having a surplus in its what? Trade in goods. Yeah, only talking about goods, so it would have a surplus in its trade in goods. However, if it would have been the contrary, so then if the expenditure would have exceeded the revenue, then we would be having a trade in goods deficit. The second component, the trade in services. This section records the value of exported services and the value of imported services. So now we are dealing with only services. That is why it is called invisible exports and invisible imports, because we are dealing with services, right? Now again, if the revenue from exported services exceeds the expenditure on imported services, the country is going to be having a trade in service surplus. So if the country is able to export more services and the expenditure it incurred on services was less in comparison, it is going to be having a surplus in trade in services. Now comes the real part. When we add the balance of trade in goods to the balance of trade in services, what do we end up getting? Balance on trade in goods and services. BOT. What's the abbreviation? BOT. Now they usually ask us to calculate the balance of trade in figure, right? So the key to remember BOT is that when we are talking about BOT, we are only talking about trade in goods and trade in services. We are not talking about primary and secondary income. That's the third and the fourth component of current account. That's the trick. It's usually tested in MCQs. That is why I made a record over here. I made this annotation over here. All right. Now, what do you mean by primary income? That's the third component of current account. This part covers two categories of income. Income earned by people working in different countries and investment income which comes into and goes out of the country. So it talks about two parts of income. Compensation of employees includes wages, salaries, and other benefits earned by residents working abroad, minus that earned by foreigners in the home country. So what happens? The compensation of employees which a resident receives, we subtract it from the compensation of employees the foreigners receive in your country. Plus investment income. Investment income covers what? Profit, dividends, and interest that again are received from abroad minus the profit, dividends, and interest paid abroad. Again, we also derive the net figure for this investment income. And what are the further components of investment income that we define? That it would include profit, dividends, and interest, right? Now, for instance, if an MNC is sending a profit back home to its home country, how would it appear in the balance of payment section of the home country? In the balance of payment, it would appear as a debit item, right? Because it's sending it back home. So again, we are going to be looking at the movement of money, right? So money is leaving the country, right? So for us, it would be recorded as a debit item. For their home country, it would be recorded as a credit item for the MNC. The receipt of dividends on shares in foreign companies and interest on loans made to foreign items will be credit items. However, what we would be receiving from foreign companies, the interest on loans or the receipts on shares, that would be recorded as credit items. So again, the key is to look at the movement of money. If the money is leaving our country, we would record it as a debit item. If the money is entering our country, we would record it as a credit item. Remember the first thing I showed you? Alright. Investment income is earned on foreign direct investment and financial investment such as shares, government bonds, and loans. So if an MNC in our country sends money back home, it will be recorded as a debit item like we discussed. Receipt of interest on loans and dividends on shares in foreign companies would be referred to as credit item because we are receiving it. Now comes the last component of current account, which is secondary income. Secondary income records what? Transfers between residents and non-residents of money, goods or services not in return for anything else. So what does this record? This include transfers of money, goods or services which are sent out of the country or which comes into the country not in return for anything else. That means what? It, it usually covers gifts, it covers charitable donations, it covers workers' remittances, aids from one government to other, right? Once we add all these four components, the trade in goods, the trade in services, primary income and secondary income, what do we achieve at? We arrive at current account balance. So, how would we then define a current account balance? A record of the income received and the expenditure made by a country in its dealing with other countries. So, finally, how would we define a current account balance? It's a record of all the income received and the expenditure made by a country in its dealing with other countries. Now, a question which arises is, what are the factors that might be affecting exports and imports, or what are the factors that bring in changes in imports and exports? So there are a number of them. The first is inflation. If a country itself is experiencing high inflation, so what is the consumer likely to do? The consumers are likely to switch to imported products, right? However, if the country is having a low or stable inflation, it's likely to be having export competitiveness, then the consumers are going to be utilizing or buying or demanding locally manufactured products, right? And as a result, exports would rise and the country would be earning more by way of its export. And it would be experiencing international competitiveness and it would be able to increase its exports and reduce its imports. The second factor is exchange rate. A fall in the country's exchange rate would reduce the export prices and would increase the import prices, making the exports cheaper and the imports relatively expensive. So this would increase the value of its exports and lower the amount spent on imports. Again, the third factor could be productivity. The more productive a firm's workers are, the lower would be the labor costs per unit and the cheaper would be its products. If there's a rise in productivity, that means output per unit of labor is more. So the firm's exports would be relatively competitive and its exports should rise and imports should fall. Then we are talking about foreign GDP and domestic GDP. If incomes abroad rises, so foreigners will buy more products because they are experiencing a higher standard of living, right? So the country would be able to export more. If incomes domestically are rising, standards of living are rising at home, so maybe imports could rise and firms would be able to buy more raw materials and more capital goods. Yes, they can be imported as well. And this rise in domestic demand could mean that some of them might switch from domestic firms to imported products. Trade restrictions, if there's a relaxation in trade restrictions from other countries, then there would be the country can experience an increase in its exports, right? And the domestic firms would be able to sell more of their products to other countries. If there are more trade restrictions, then we won't be able to have sufficient or sizable exports. Quality of goods and services, again, is a big factor. A fall in the quality of a country's products would mean that it won't be able to sell or make sufficient exports, right? In contrary to the other country's products, and it would have then an adverse effect on its balance of trade in goods and services. If, however, its quality is high, it would be able to make sizable exports and earn sufficient export revenue. Marketing efforts again play a vital role. The amount of exports sold is influenced not only by a country's quality of goods and services and the price of its products, rather, the efforts the domestic firms make in marketing their products. So, similarly, it also depends upon how the imported products are positioned and what strategies they adopt in order to make an influence in the consumer's mind. So, the higher the marketing expenditure made and how tactfully they place it, and if it's able to grab hold of sufficient demand, then the exports of your country can rise. However, if the imported products are famous and highly demanded in the home country, then the imports would be relatively more. So, these are the 8 factors that influence imports and exports. We'll come in the second section looking at the factors, the causes of a current account deficit and surplus, and how it affects, and the strategies to restore a sound and stable balance of payment. Stay tuned, subscribe,